Hello friends, welcome to this video on Gap Advisors channel. Myself CM Manish C. Iyer. In this video, we will discuss about the opinion of Expert Advisory Committee EAC in short of the Institute of Chartered Accountants of India, the ICAI in short, on preparation of statement of profit and loss, which we will call SPL, by a non-revenue generating entity, which is published in May 2023 edition of the Chartered Accountant Journal. The facts of the case is that a special purpose vehicle SPV has been set up for execution of East-West Metro project in one of the metro cities. The company has no income because another organization will be earning a revenue from operation and maintenance of the metro rail, and bases a letter of Ministry of Railways, interest earned on the funds released by the government lying surplus shall not be recognized as income in profit or loss. Therefore, the statement of profit and loss has only expenses in it, and the company has been reporting losses since incorporation. However, the facts submitted by the company say that the company is not a loss making company, and the statement of profit and loss is not giving a true and fair view. As the company does not have any income, the question of making either profit or loss does not arise. Hence, after consultation with the statutory auditor, the company did not prepare and present statement of profit and loss SPL for the year ended 31 March 2021. God save the world from such auditors who agree to whatever the management proposes. However, C&AG objected to this, referring to an earlier opinion of EAC. You can see that neither the company nor the auditor nor the CAG are looking at the requirements of Ind AS in this regard, but are going by their own theories and EAC opinions. That is why I say that EAC opinions have created a new version of Ind AS. Accordingly, opinion of EAC was sought on whether preparation of SPL is required in the current scenario or can be done away with. The EAC has considered only this issue and has not considered whether the contention of the company, auditor and C&AG that the company has no income is proper. Therefore, EAC, noting the requirements of Section 129 of the Companies Act 2013 and paragraph 10 of Ind AS 1, which deals with presentation of financial statements, has rightly opined that the company is required to prepare SPL every financial year, irrespective of whether it is earning profits or losses, and that there is no revenue or income being recognized in the SPL. However, the facts were not digestible for me. I could not understand how can there be no income when the company is rendering construction services. In my view, EAC has the ability to call for required details and must have considered this issue of whether the contention of company, auditor and C&AG that there is no income is proper, so as to provide a required direction to members of ICAI on compliance with Ind AS. In further slides, we will discuss on this issue basis the limited information published in journal. I have visualized the extract of balance sheet of the company. Suppose the company has received 2500 crore from the government, which it recognizes as equity share capital. Of these, the company has utilized 1,000 crore for construction of the metro project and 500 crore for payment of various expenses. Rupee 1,000 crore is still left in bank. On these rupee 1,000 crore, the company has earned interest of rupee 120 crore, which the company has adjusted from the cost of the project. Given this balance sheet, let us understand whether accounting is proper. Para 12 of Ind AS 23, borrowing costs, permits reducing the cost of the qualifying asset with interest income. However, that reduction is permitted only if it is earned from investment of borrowings and the cost of those borrowings have been capitalized. In our case, there is no borrowing. Therefore, Ind AS 23 does not apply. Accordingly, in the scenario that we are considering, the interest earned must be recognized as income in profit or loss. Para 7 of Ind AS 16 states the principle for recognition of property, plant and equipment. One of the conditions is that it is probable that the future economic benefits associated with the item will flow to the entity. In the given case, the company has submitted that it is not earning any income out of the project. Therefore, it is not probable that the future economic benefits associated with the item will flow to the company. Accordingly, the cost incurred for the project cannot be recognized as property, plant and equipment and must be recognized as an expense in profit or loss. Based on the above discussion, the balance sheet of the company would then appear as shown in this slide. Total asset comprises of only bank balance and all costs and interest income are recognized in profit or loss and accumulated in retained earnings. This shows the extract of the statement of profit and loss. Interest has been recognized as income as para 12 of Ind AS 23 is not applicable. Therefore, if all funds received are recognized as equity, the interest earned must be recognized as income in profit or loss. Accordingly, the contention of the company auditor and C&AG that the company does not have any income is not proper. The question that remains unanswered is whether basis a letter of Ministry of Railways, the company can divert from the requirements of Ind AS. There is a pervasive issue of when and to what extent law prevails over standards. NAFRA must issue a clear guideline on this, as many PSUs and even other than PSUs are taking advantage of this to manage their financial position and financial performance. One may argue that the company could have recognized the funds received as borrowings with only the minimum amount being recognized as equity capital. In that case too, the question of capitalization of borrowing cost and interest income does not arise as no item of PP can be recognized. Further, as no cash flows are generated, the company would not be able to repay those borrowings. Therefore, the argument that the company would have treated the funds received as borrowings does not appear logical. In our view, the company has not applied Ind AS 115 revenue from contracts with customers As per the facts submitted, the company was set up on 9 July 2008 for execution of East-West Metro Corridor project in one of the metro cities. Para 6 of India's 115 states that an entity shall apply this standard to a contract only if the counterparty to the contract is a customer. A customer is a party that has contracted with an entity to obtain goods or services that are an output of entity's ordinary activities in exchange for consideration. Another organization will be operating and maintaining the executed project and thereby earn a revenue. Thus, that other organization is using the executed project and hence is a customer for the company. The consideration is the amount the company is receiving from the government, which controls both this company and that other organization. The company is receiving the consideration from the government on behalf of the customer. Thus, the company is rendering the service of construction of the metro rail for which it receives consideration from the ministry. Therefore, the funds received shall be recognized as contract liability to the extent the work has not been performed. To the extent of the work performed, the contract liability shall be recognized as a revenue from construction services in profit or loss. The company shall recognize interest earned on unutilized funds as income in profit or loss. Therefore, assuming that the minimum equity capital required and recognized by the company is a rupee 1 lakh and the company has performed work to the extent of rupee 1500 crore, assuming no margin on costs incurred, the company would report profit for the year of rupee 120 crore. This shows the extract of the balance sheet. If the company recognizes a revenue from construction services, as the company constructs the project for another company, no PP is recognized. The bank balance is the same as before. Equity share capital is of rupee 1 lakh, which is considered as minimum amount required. The profit earned by the company is shown in retained earnings and the funds received for which work is not yet completed is shown as contract liability. Therefore, in our view, the accounting by the company and agreed to by the auditor and C&AG that there is no income is not proper. Thank you for watching this video. Request to subscribe to Gap Advisors channel if you have not already subscribed. Do post your comments on this video giving your views. Please register on gapadvisors.com if you have not already registered. On a registration, you get 48 hours of free subscription access to all repositories. Submit your issues on Ind AS and Indian GAAP on gapadvisors.com. Practice task solo, the learning or the earning game on Ind AS and Indian GAAP. Top 5 task solo rankers will get cash award of rupee 5000 on 1st June 2023. So what are you waiting for? Register now and start task solo. Hope you found this video useful. Thank you.